And yeah, there was one more issue that happened at the exact same time. Remember, this is the earnings season. All the four large names in our universe and in the AI universe, Amazon, Google, Meta, and Microsoft, they came up with earnings. Now, the problem that the market saw with these earnings is on your slide. Each one of them, starting with Microsoft at the lowest number, $120 billion, to Amazon, who said that they will spend more than $200 billion in 226 alone, not for 5 years, not for 10 years. This was their Capex estimate for the calendar year 2026. And this kind of overwhelmed the market. The total between the four, and these are just the large four, the overall Capex is expected to be $1 trillion. Just between these four companies, they estimated that they will spend $650 billion. And this is roughly, for Google and Amazon, it was 40% above what the street was estimating, 30-40% above. Now, that really scared the market, because when companies spend these type of amounts on Capex, the street gets worried whether the returns will follow or not, because the Capex happens in this year, the returns will come over the next 3 to 4 years. And if those returns don't come, it's a problem. And that's what got the street really worried. And just to give you a reference point about how big this Capex is, 200 billion Capex by Amazon in calendar year 2026 on AI is roughly equal to the entire market cap of Reliance Industries. So they are spending one Reliance Industries value in just calendar year 2026. So that is what the magnitude of the spend is, what is really caught the street unaware, and people started getting worried about the returns on that. Again, I cannot stress enough, this happened in the same week where we saw the healthcare regulatory issues, the software issues, and the flash crash in gold and silver. So you put all of that together and you can see how a concern like this, which would have caused a 2-3% drop in these companies which announced this Capex, it led to a 10 to 15% drop in each one of these companies. Some of the companies like Google were spared because of the market's confidence on Google, but the other companies were not spared. And of course, Meta was also spared, but Microsoft and Amazon were not spared. Both of them saw drops of 10 to 15% in that week. Now, why we feel that this is not a concern? First of all, the whole reason that they are spending is because that part of their business is growing at the rate of 40 to 50%. Now, this is not a small startup company where your revenues can grow at 40 to 50%. Google's estimated, and this is before their earnings results, their estimated CY26 revenues for their AI business, just the AI business, not the entire search and the advertising business, which is the largest part of their business. Just the AI infrastructure business, the estimated revenues were $80 billion. So you can imagine this $80 billion is growing at the rate of 40 to 50%. This is just crazy growth. I have never seen in my entire stock market life in 20 to 25 years, I have never seen a $80 billion business grow at 40 to 50%. That is just unheard of. So that is these numbers are just so difficult to digest for people. And it happened in the same week that there were all these concerns and the market sell off. Now, we are not worried because the whole reason that they are spending is because they're growing. And then you have to worry that, okay, they're spending, they're growing revenues. Is it profitable growth? Are they making money over there? And so that proof is always in the numbers. And we can validate it with numbers. For example, Microsoft, their EBIT margins in the Azure business, which is the AI software, AI infrastructure business, not entire Microsoft, not the software business, just the AI infrastructure business where they are spending $120 billion, just that segment, their EBIT margins are 43%. If you have a business that and growing, if you have a business that can give you 43% EBIT margins, why would you not spend on it if there was customer demand? It makes sense that Microsoft is spending on that. We totally agree with it. Unfortunately, the street is worried. And so we are not too worried about that. And another company, so you compare competitors, right? Google. And this is not Google's advertising business, which is a pure cash flow. It's a cash machine. We are not talking about that business. We are talking about the cloud AI infrastructure business, which is where they are spending about $180 billion. Okay. That segment EBIT margins, if you see in the first quarter of 23, when the whole AI revolution started with ChatGPT, it was at 2.6%. In the last quarter, in September quarter of 25, they reported that as 23.7%. And in the December quarter, that went about 24%. So when you have such growth in margins in a business where you are growing a 80 billion top line business at 40-50% per year over year growth, it's just mind blowing. And we don't see any issue over there. The street definitely got worried, but we are very confident that this is a very strong business. And their RPO, which is a measure that these companies use. RPO is the forward booking or the revenue that has not been booked, but they have the orders. That is also growing at 60-70% year over year, right? So their orders for the next 2 years are booked. It's not like you have to worry about whether they'll grow. Okay, this year they are growing 60%. What happens next year? Next year they are growing at an equally fast pace because you have the orders. You have the revenue in the RPO order book, which is pending. And so, and the valuations are not high. You are not talking about 100 PE company. Google, Microsoft, they all trade in the 20 PE ratio range, right? 20 to 25 range. So you are not paying for that 60-70% growth in these businesses. And so that kept us pretty level-headed. We did not get into any concerns about these companies. We did not do any panic selling. And so this is the time when actually we were telling our investors that if you have the conviction, if you have the cash flow, you should invest. This is a good time to invest. And we continue to say that these issues, they happened at the same time. Some of them are real issues, some of them are not. We obviously differentiate between the two and move our portfolio in the direction where we don't see issues. But when the market sells, they sell everything. So this is the time we actually churn our portfolio a little bit and get into stocks which we feel we could not buy in the last 2-3 years. And so absolutely a good time to invest. I know this will be a common question that we get on the webinar as well as in our interactions with all our channel partners and clients. This is a very common question. In spite of all this madness that you see in the market, we do see calmness, in the days ahead in the market. And these are the times where if you were complaining about valuation in the last 1 to 6 months, that complaint is not valid anymore. But now if you get worried because the markets have crashed, you are getting mouth-watering valuations. And now if you don't pull the trigger, then you cannot have it both ways. You cannot have low valuation and a bull market, right? They don't go well together. So either you will have a bull market and valuations will be high, or you will have a market like in the last 2 weeks where stocks have crashed and the valuations are mouth-watering, but you will be scared. And we understand that it is quite normal to be scared, but this is the time where you have to show that you are open to good deals, good value in the market, and you are ready to invest. And we do feel this is one of those times where we feel over the next 2-3 months, the markets will calm down a lot. And these valuations, you may not get them again.